So a very, very important part of this chapter is understanding risk, right? And we're going to understand how to manage your risk. Because when it comes to trading, obviously in the last part, I mentioned stop loss quite a lot. So when it comes to managing risk, this really is like the number one thing you have to do in trading. You can be a brilliant trader in terms of like having a really good eye for markets, you're great at analyzing, but you can still lose money if you don't manage your risk correctly. So this is a super important part. Definitely watch this 2 or 3 times if you're new, and just 100% remember that you cannot make money in trading if you do not understand properly how to manage your risk. So the reasons why risk management is important. When it comes to trading or investing in anything, the number one thing that you want to do is preserve your capital, right? So you need to manage that risk, because in trading, it is very, very easy to lose a lot of your account, a lot of money quite quickly, especially if you're using what's called leverage, which we'll look at a bit later. It's very, very quick and easy to lose money. You'll find that a lot of traders have in their past blown an account, which you really don't need to do if you have the correct education to start with. But people that try and jump into trading without being properly educated will very often blow an account, because they get very, very greedy, a lot of psychological factors too. And yeah, it's a very important thing to understand. So the first aim of trading, like I said, is to preserve your capital, not to make super quick, massive gains. Of course, everyone's in this for the money, that's the point, but you cannot create the upside unless you manage the downside. That's just a very important phrase to remember. You cannot create upside unless you manage your downside correctly. So therefore, if you do manage your risk sensibly, you can create steady profits without kind of having the super volatile swings in your equity curves, and running that risk of having that one loss that undoes like 2 months of work. Because the worst thing would be making those gains. You have a really good couple of months, and you have a week of just really silly mistakes where you just throw all your risk management principles out the window, and you could lose all of that profit from those previous 2 months in the space of a week. And you can imagine how devastating that would be. So you can get lucky. People that just completely disregard risk management, you'll find 1 or 2 of them in 100, or one or 2 in 1,000 will get very, very, very lucky and do extremely well. But of course, if you continued on that path, you would probably end up losing it all again. So in the long term, even though this might seem a bit boring, I don't really want to manage my risk like this, I want to just go gung-ho in the market and make massive amounts of money. Well, okay, yes, it's possible, but it's extremely unlikely in the first place that it's going to work. Plus, if you continue on that path, you will probably lose a lot of it, if not all of that money you've made, because the markets are not a casino. At the end of the day, it's like professional investing, it's professional trading. It's what you want to be aiming for, making those steady growth without the crazy volatility in the equity curve. And you'll be surprised how the fact escapes a lot of new traders. They just disregard it completely, jump into the market, get burnt, and then come back to this after. There's no point in wasting that time and money. Just do this from the outset, and you'll make those steady gains. It'll be a lot more likely you'll make those steady gains. So how are we going to manage risk then? What's like the calculations behind it and the basic sort of principles of it? So when you view your risk, it's good to view it in percentage terms instead of in like pounds or dollars or euros, whatever you're using. Because if you think to yourself that, okay, I want to risk £100 a trade, immediately as soon as you have that thought of risking £100, you associate that with, obviously with money and what that can buy you. And you might think, well, if I only risk £100, then maybe I can only make 200 if I have like what's called a 1 to 2 risk reward ratio we'll look at later. And 200 is a good amount of money, but you might think, well, I want more money. I want to make £1,000 on the trade. So when you have the sort of like monetary attachment in your head, you start like going off into these tangents that you shouldn't really be going off into. So when you think about it in percentage terms, you think, right, I'm going to risk 2% of my account, my equity in the account. You start being more professional, more like a business, right? Instead of thinking, I'm going to risk 150 quid now. I'm going to risk 200 quid tomorrow because I had a good trade yesterday. That will ruin you very quickly. So think of it in percentage terms. You have your own personal risk tolerance. If you have a decent size account, you don't need to be risking like 10% of the account, because there's no need. It's a big account in the first place. You can make decent gains risking maybe 1% or 2%. So when we're thinking about it, always think about it in percentage. And it's also very easy to do that, because if you have like let's say £10,000 in the account, and you're thinking, oh, how much do I risk? Do I risk £120, 160? Last time I risked 150. Should I do £160 this time? There's no need for any of that sort of like craziness. Just you know how much you want to risk in percentage terms. So let's say that you took a trade and you risked £1,000 of your account because you're like, if I put £1,000 on this trade, I might win £1,000 if it goes the right way. When you think of it in those terms, it's like you're at the casino again, gambling. When you think, right, I'm going to risk 1% of my equity, therefore it gives me sustainability in the long run if I take some losers, and we'll look again at, like I said before, risk reward later, which can allow you to outsize your profits based on your losses. The percentage makes a hell of a lot more sense when you're doing it that way. So let's say you risk £1,000, you're actually risking 10% of your whole account. So of course you're like, well, yeah, obviously £1,000 is 10% of 10,000, but really think about it. You're risking a tenth of the whole account in one trade. So let's say that you take 3 losses, almost a third of your whole account balance is gone. That's why I'm saying it's very, very quick to make bigger losses if you don't factor in the risk management principles. So think of it in percentage terms. It's 10% is a lot. Therefore, £1,000 is a lot for that account size. If you have £1 million account, £1,000 is not going to be very much. But then, of course, again, you just use percentage terms because you can scale that all the time. If you know that you can make consistent gains by risking 1% of your account every time, well, you can scale the size of the account and not change anything else, but the money increases. Whereas if you're always thinking about the money, it's going to change all the time. That's quite a powerful concept, is that scaling concept. So you really do need to use sensible amounts of percentage risk. Depending on the size of the account, you may be wanting to risk a little bit more if you have a smaller account because it doesn't really mean as much. If you've only got £1,000 in your account and you risk 1%, it's really quite small. Whereas if you've got £100,000 in your account and you're risking 1%, that's quite a lot of money. So that's why it can sort of change slightly. It's depending on your risk appetite and your account size. But you'll find most traders use somewhere in between 1 to 3% per trade. So personally, I use 1% at the moment. Sometimes I've used 2% in the past, but 1 to 3 I think is a pretty good amount to use. So if you start going into the higher numbers like 5, 8%, 10%, it really gets a bit dangerous there. Because even if you're a good trader, every trader, no matter how good you are, will take losses and will sometimes take a string of losses. So if you're consistently profitable and you decide, okay, well, I think I'm really good. I've had a good 6 months of trading. I keep making money every month. Well, next month could be your losing month. And if you decide I'm just going to go straight to 10% risk now and just make loads of money, and then you just have a losing month because your psychology goes off because you're risking more, you can see how it goes downhill very quickly. So choose how much you want to risk and try and stick to that same risk every time. And as your account grows, the money will grow, even though the percentage stays the same. Now, how do we calculate the risk? So I'm going to show you some sort of the basic equation, but luckily you don't need to know kind of the maths behind it. There's many calculators you can use, and I'll also give an example of how to use one of those calculators. But it's quite easy to calculate risk in FX when you know your parameters, because you can use these calculators. So what are the parameters when it comes to trading? Well, you have your dollar amount, because of course, so your pounds or your euros or your dollar, and your pips. That's pretty much it, right? You have the amount of money you're risking, which will also be a percentage, but for now we'll just say that the money we're risking, and also how many pips are risk on the trade. Now remember back to the previous part when we looked at stop loss. So let's say that your stop loss is 30 pips. That's your trading denominated risk. And then your money denominated risk could be £100 if that's how much you're risking per trade. So therefore, you have a £10,000 account, you're risking 1%, that's 100, and your risk in pips is 30 on that trade. So the risk in the pips will change quite a lot because your trades are always changing. So therefore, you divide your risk in money by your risk in pips, and it tells you how many units of money you will kind of go long or go short, so buy or sell per pip of movement. So therefore, let's say you have a £1,000 account and you use 1% risk every time, always staying the same, £100. Therefore, you just do 100. Let's say that your trade size gives you a 27 pip stop loss. That'll always change, but for this specific trade, 27 pips, that equals £3.70 per pip. So therefore, you know that for every single pip that market goes up and down, you kind of gain or you will lose £3.70. Of course, the market is priced in pipettes, so technically every tenth of a pip, it's going to be a tenth of that. But overall, kind of really looking at it in pip values because that's the main denominator. So the problem is, depending on the way that you trade, with your spread betting, like the previous way, it's kind of easy. But if you're using most trading platforms, it's going to be done in lot sizes because it's CFD, contract for difference, and in that case, one standard lot, because it's divided into different lot sizes, is always equal to $10 a pip. So if you have a pound denominated account, you're still trading based on lot sizes in dollars. So that kind of needs to be converted to pounds and then dollars. And if you're trading, let's say, Kiwi Aussie, so you're trading NZD USD, there's another conversion calculation to do. Luckily, you don't need to worry about that because there are many calculators you can use to do all the hard work for you. Let's take an example of that. Now, here's a position size calculator here, and we can see the various parameters that I've entered. So the account currency is the account that you have. Let's say your account size is 10,000. You want to risk 2%. You can swap that for money if you want, but just, we're doing percentage terms. And we use in the previous example, I have a 27 pip stop loss. And like I said, that will always change. Now let's say that your currency pair is Euro Swiss franc. So in this case, there's another currency conversion to do. So it's asking me to enter what the current pound Swiss franc ask price is, so the sell price. That in this instance was 1.26540. So now I'll calculate that, and it will give me the amount of lots I need to enter. So in this case, I'm going, let's say I'm buying it, and I'm buying 93,733 units, but because it's done in lot sizes, that's equal to 0.937 lots. So if you're brand new, that might be pretty crazy what's just happened, but really, there's going to be many different versions of calculators like this. They all do the same thing. So don't worry about it, basically, because you'll know your parameters before you enter. The calculator will tell you how many lots to place in. You place the lot size, double check it, and that's it, you're done. So therefore, if you're risking 2% on this account size of 10,000, it means that you cannot lose any more than 200, plus or minus a tiny little bit amount of something called slippage we'll look at later, but you cannot risk more than, you cannot lose more than 2% or £200. So if you place that lot size in and you place your stop loss, make sure it's there, then you know that you're safe. And of course, then you can calculate your potential profit if it goes the way you want to. So there's our lot size at the bottom. That's where you enter into the system. So now I want to take you through the risk to reward ratio, because remember when we first started this part, I mentioned that it's possible to, if you do keep your risk low and you keep your risk the same each time, you can have a higher amount that you can win or that you will gain than you will stand to lose. And that's the risk reward ratio. So if your risk reward ratio is positive, so above 1, it means that you're standing to gain more than you may stand to lose. And of course, if you can be consistent, this is one of those ways that you can work towards consistency, is taking trades that will give you potentially more reward than you would potentially lose. So let's have a look at some examples in a second as well. So we really want to gain more in profit than we stand to lose, because if you're risking, let's say, 2% on that trade, and your take profit is set only like 0.5% higher than the current price, you're standing to potentially lose 2% on that trade, and the max you can win or gain based on your take profit is 0.5%. So you can imagine that your win rate, the amount of trades you win, would have to be quite high, or very high, for you to actually even break even for that sort of thing. So if you're standing to gain twice as much on average per trade than you stand to lose, you don't need as high a win rate to actually make money or break even. And this is the risk reward ratio of the trade. So let's say we have a trade and you stand to lose 50 pips, and it can be any monetary amount, any percentage amount, and you also stand to win 50 pips. So therefore it's a 50-50, it's a 1-to-1 risk to reward ratio, because your risk is 1 and your reward is 1, because it's the same, it's a mirror. So therefore you have an equal risk reward. Now that's fine, because you would need 50%. Let's say you only ever took, and this never really happens, but let's say you only ever took 1-to-1 risk reward trades. You need to win at least 50% to break even. So you'd obviously need a slightly better than chance win rate to actually make any money. Now, very rarely is any trader going to have always exactly the same risk reward. So one of your trades might be 1-to-1, the next one might be really good and 1-to-5, and then you if you win that 1-to-5 trade, that counts for 5 potential losers. So see how you can sort of work towards good risk reward ratios to be more consistent more easily, even though you still are going to lose some trades. So the higher the risk reward, the better. But obviously you might think, well, can I find some trades that are 1 to 100? Not really. You have to be a bit sensible with it, still a bit more realistic. But as long as you are above 1 to 1, you just need to be, you don't even need to be better than chance. Let's say your average win rate is 1 to 2. You can win, or like, you can take profit on less trades than you lose and still make money. So that's how we can utilize this idea in our favor. And there is no correct ratio because, like I said before, everyone's going to be different. Every trader, even if you have one set strategy, there'll be different risk reward all the time. Very, very likely anyway. So don't worry about what the correct ratio is. As long as you're doing over 1 to 1, you should be good. So a couple of examples of that on the chart, just to make it extra clear. On the left-hand side here, you've got the first one, which has a tick next to it, because this is a 1 to 1. So if you look at this, your risk is, let's say, 36 pips, sorry. So 36 pip risk and a potential take profit of 36 pips. So what's that going to be? It's going to be a risk to reward of 1 to 1, because the risk is 36 and the potential reward is 36. So therefore that's a 1 to 1 risk reward. That's fine to do. Now the second one here is even better, because you can see that the green space is bigger than the red space. So in this example, you've got 23 pips of stop loss. So if the market does go down by 23 pips, you're out the trade, but your potential reward is 46. So now we have a 1 to 2 risk reward ratio. That's very, very good. So if you can keep up trades like that consistently, you can lose more trades than you win and still make money. And of course, your monetary amount will always remain the same. So on the first trade, you have a 36 pip stop loss. And let's say you want to risk 1% of your £10,000 account, you're risking £100, and then you take another trade with a 23 pip stop loss. Well, you would just adjust the lot size. So you adjust your position size to be bigger or smaller based on the stop loss. So your stop loss is always changing, the amount of pips, but your actual money risk, your lot size risk will change to adjust to that. And what about the last one? And number 3 is not really very good at all, because you've got a pretty large risk there of 72 pips. If you had a 72 pip potential reward, that's fine, it's a 1 to 1. But in this instance, you're only standing to gain 36 pips. So yes, you might win, you might take profit, but if you keep taking trades like that, it's going to take only a couple of losers or one loser to outdo all your winners. So that's a 1 to 0.5 risk to reward, because risk is on the left, that's always 1, but your reward is 0.5 of that risk. So therefore it's really no good. Like there's not, you could trade like that, but you'd have to be winning 75% at least just to break even, and that's not easy to do. So that's your risk reward ratio. So really can't stress it enough. This is a very important part. Make sure you understand how that works, all the risk reward ratio stuff, how to manage your trades properly, and you can look at various calculators to get used to that idea. And please, if I can say one thing, always use a stop loss. That's the number one thing to remember. So that's how to manage your risk.